Good morning, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the share disclaimer. Be aware that neither Dimitri, myself, or Market Chameleon are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show and webinar are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and we'll invite Dimitri to the stage. Good morning, D.
Good morning, Will. How are you?
Good. Today we're looking at how to run option theoretical values.
Yeah, let me first share my screen, and then what I'll do is show you guys an example of what how to run theoretical values on options and how it could be useful to you as a trader. I'm going to use SPY for our example. So when you type in SPY in the search box above, like this, you click on SPY, you come to the SPY main page. On the left-hand side, you have your menu for SPY. Go to options, click on option chain. That's what we're going to use for our example. And I'm going to just close this menu to expand our screen. And the idea here is when we go to look at option prices and option values, we first want to look at the market prices. To observe the market prices, we use an option chain because in a particular stock like SPY, what you have is different option expirations, as you could see listed here on the left-hand side. So on our list here, it starts with options expirations that expire to the nearest term expirations, and then as you scroll down, it goes out to the furthest expirations. I'm going to just go out a little bit further. This is as of Friday's close. We're not open yet. This option expiration already expired. So let's go out over here to May 16th. If you click on it, you'll see on the right-hand side, you have this option chain. You could look at option montage or option chain, and you will see that different options here. You have the call options on the left-hand side. You have the put options on the right-hand side. In the middle, it tells you the strike, corresponding strike. So here, if you see 564 strike option, the calls on the left-hand side, you see the bid, 672 bid, the offer and the call, 676. And in the put, the 564 put, you have a 611 bid and an ask of 615. So this quickly lets us look at the market prices and market values of the options available to trade. And as traders, when we look at the market prices, a natural question would be, well, what do we think it's worth relative to where the market is pricing? Okay. And that's what we call a theoretical value. Okay. If we gave this option certain assumptions, or if we gave, if we created certain assumptions based on our future outlook, what would we value these options, and how far does our valuation diverge from the market prices? And that's a very important concept in trading, because valuation models are one of the most important tools that traders will use. If I gave it an analogy, maybe think of it this way: you're looking at an investment property, and you know the market price of the investment property because it's for sale for X amount. So now you have that information, but what do you think it's worth in theory if you gave it some assumptions? So we could give it assumptions, let's say I think that I could get $10,000 rent per year on this investment property. I think that the taxes will be X amount. I think insurance will be X amount. I think I'm going to need to fix it up a little bit. That will cost me X amount. So then I create and based on that, I'll have this much left over, right? Like here's the assumption. I'm going to make this amount of rent. These are my expenses. This is what's left over. And to value it, I need a, whatever capex of 10%. So then you did your valuation model and you said, okay, based on this, I think that the value of this property is $110,000, and the asking price is $100,000. So in theory, it's below my theoretical value. Now, of course, you can't price exactly something, to the penny. Like this is what it's based on assumptions. So you might have a range. You might say, oh, well, maybe if I didn't compensate for this or this worst case scenario, or maybe my rent is off, maybe this. You could give it a range. You could say, I think it's between 100,000 to 120,000, right? So you give it a mid 110. So where does it fall, relative to your assumptions? And that's important when you're looking and trading, market prices, to have, your models helping you out. Now, the markets just give us the market prices. You have to create your theoretical values. Every trader might have a different opinion, creates a theoretical value. And over here, we have a starting point. So in the middle here, it says Theo. So you have the market bid, market offer, market bid, market offer. But we need some kind of reference theoretical value to get a sense of, is this on high end, low end of my assumptions? And the default is just taking a look at the market prices and using a smoothed out curve to see if anything, like obviously, like falls way out of the line of a smoothed out curve, because you could see here that there are different implied volatilities in options, and going up and going down. And if we ran a smooth curve, what would those theoretical values look like? And then does the call and put parity hold? So if that doesn't hold, maybe there's a assumption and cost of carry that we're not looking into. So we have this option pricing model, right? We have an option pricing model, like Black-Scholes, Binomial, and so forth. And that option pricing model needs assumptions. We put in our assumptions, looking at, you get cost of carry. What do you think interest rates, dividends are in this stock? Is what do you think implied volatility is? And all these other assumptions that go in there. And then we could run a valuation model and observe what the value is relative to the market prices. So now let's say I want to run a assumption based on an implied volatility, and I want to see how the market prices compare to the value of the option if I ran a certain implied volatility. Okay, that's where this theoretical value drop down comes in handy. So so it's defaulted to best fit. I'm gonna drop that down, and I get this selection box that allows me to create an option value based on certain assumptions. Okay, and this is based on the volatility assumptions. My forward-looking implied volatility assumptions. And here we have a couple different options to select from. One is you could give it a custom volatility. So let's just say I think SPY will, in the next whatever days, these are 7 calendar days, 5 trading days left, right? I could give it my estimated volatility, plug it in there. Like if I click on this and say I think it's going to move at a 20 vol, let's say like this, I think it's going to move at 20 volatility. Okay. And if I click OK, based on a 20 volatility, now this Theo column and this Theo column, one for calls, one for puts, it'll run a theoretical value for each option. And based on the 20 volatility, it will say, well, if the SPY on average trades at a 20 volatility in the next 5 days, then we could go to like the 570 call, for example, and look at a 570 call option theoretical value. It'll say, in theory, this option is $4.10. And then we could compare it to the volatility, the option prices, the market values, 387 versus 388. We could see that both the bid and the offer are below that theoretical value. Okay, so that's one way to run a volatility and then compare it to the market prices to see how far away those market prices are from your theoretical value. Now, let's say we wanted to drop this down, and maybe we don't know, we don't have an exact volatility assumption, but we wanted to see what if here's 20-day historical vol. What if the SPY, click on this, moved around in next 5 days to the same, based on the volatility we've seen in the last 20 trading days. So if we looked at the last 20 trading days and said, let's use that as our assumption that the next 5 days will look similar. We click on this and it's going to run a 20 base, calculate the last 20-day historical volatility in SPY and plug that into the implied volatility assumption. So let's click OK. And now what we see is that now you see all these columns are a little green. And green means that in our situation that the the theoretical value of the option is above the market prices, above the ask. Right? So 737 is above $6.76. So all these greens are just telling us all these options are theoretically undervalued if the next 5 days we see volatility trading similar to the last 20 days. And if you could see it going down, you could see these puts. The red means that the theoretical values are lower than the market bids. So here on the 541 put, our theoretical value is 68 cents. The bid in the put is 81 cents, offer 83. So the red just quickly visually just points out, our theoretical values are below the bids. And here we see a skew, right? So I'm running right now a same volatility, implied volatility for each option. There's no skew in our theoretical value. So we're just assuming the same implied volatility for each option. And that gives us a quick assessment and visual how far away our Theo values are from market prices. And it's a starting point. We could always then start tweaking it, or compensating for other things and moving those implied vols around. But Here we have a quick way because you have all these options. Right?
Hey,
All
D.
these options. Yep.
Rob asking, is this a newer feature? He hasn't been aware of this, so he was just
Yeah. No,
asking.
this has been around. No, we had this feature.
There you go.
Yeah, we've had this feature. It's a feature available to you guys to, change assumptions and see quickly. Well, all right, how do I compare these market prices to a
That's why
theoretical?
coming to these webinars is so important. Every day we learn something new. Great job, D. Thanks.
And now, and let me give you another example of another way we could use this, and by using a custom volatility. So let's say I'm looking at the money implied vol, and that the money implied vol we'll use as the 564. All right, and we could see like right around 564 we do have the implied volatilities. We could see these are the bid implied volatility of this option. This is the ask implied, because implied volatility, it's a derived value. One of the assumptions, in the option pricing models, you need an option price. Well, an option price has a bid and an offer, so you'll have two different implied vols, right? But let's say we ran an implied volatility close to that, the money, but we wanted to use that implied volatility for each option to see how things are skewed, right? So if everything was exactly the same implied volatility, then there's no skew. But let's plug in a custom volatility. I'm going to put custom, and I'm going to set it to, let's put it 20.2. So 20, right, 0.2. I'm going to hit OK. And now this is going to run a theoretical value based on 20.2. Okay. So you could see here that here we're already close. We're 70.7, right at this 20.2. That's exactly where this offer is, $7.76. But if we go up, we're like, okay, well, here the implied volatility is 18.8 in the offer, making this call $2.78. But if we use 20.2, if we just said, okay, what if we just use the at the money as our forecast? How much how much skews in it? Because obviously that is skewed lower. The upside call is skewed lower in implied volatility than this call, right? 18.8 is lower than 20.2. And it's doing that because the assumption is, well, if SPY goes up, implied volatility will come down because there's more certainty. So it is giving it a skew, but maybe our assumption is it won't. Maybe our assumption is even if it goes up, it'll stay. That volatility will hold. And if it does, well, what is our theoretical value for that call compared to the market prices? And how much do they diverge? So that's what this is. Now we have a value of $3.19 according to the option pricing model. And we could compare it to the ask of 278. So we could see that there's a price divergence, right? Of like 40 cents almost. And that gives you, is that enough for you? Is that option look good to you or not good to you? But at least you could have in theory, an idea of, the discount or the skew in that call and relative to an assumption that you're making and how much they diverge. Okay. So these are important tools and features to, start looking at options and making quick valuations. And then, of course, that's a starting point. It's always a starting point. You'd have to go and do more research, just like if you're going and buying an investment property. you have a starting point, you have your model, you have your tools to make evaluations, but you still have to go in there and do additional research, because situations are always changing and dynamic, and you'd have to look for all your other things on your checklist. But this at least gets you a quicker way to kind of apply a base model kind of across the board. So I'm going to stop right there with this example.
Stefan is asking, would you do this instead of a smile analysis?
Yeah, I mean, this is a different type of analysis. A smile analysis is looking at the skew as we observe it, right? So the skew, a smile, is looking at the curvature of the current. In this case, it would be a vertical one, not a horizontal. We're looking within the same expiration, and there you want to compare a smile versus maybe a historical smile. Right? So you could. It's another analysis where we observe a skew in a certain stock, like SPY, and we could observe a certain skew in SPY during different conditions, like volatile conditions, non-volatile, and how options relate to each other. Okay, so it's a good question, but it's a different type of analysis when you're looking at analyzing the entire smile, the curvature. This is looking at kind of the options relative to a value that we're giving that option based on the option pricing model.
Rob is asking, there are other boxes on the top too, like stock historical moves over time could be very helpful. Maybe we can look at those tomorrow. He's asking.
Yep.
Great job, D, as always. Thanks everyone for joining. Any final words for the team, D?
Yeah, thanks everyone for joining. Stay safe out there. Hopefully you guys could join us tomorrow. We'll continue on some of the conversation and ideas we've introduced today to just continue building on top.
Excellent. Great job. Thanks everyone for joining us. Remember to like and follow us. Some thumbs up on YouTube are always super helpful. And everyone have a safe day with this market rip. Have a great day, everyone. Bye.